Howdy, Jacob here. Today we're looking at Ascent Industries in the metals and mining industry. Or Ascent, yeah, sorry, I confused myself. Ascent Industries is the company in the metals and mining industry, 100 billion market cap and enterprise value. They produce and distribute stainless steel pipe and tube specialty chemicals in the US and internationally. There are two segments, their tubular products and their specialty chemicals. Okay, return on invested capital has been in the double digits, but is very inconsistent and very cyclical in the fact that their earnings are pretty commonly negative and then positive again. So you're definitely going to want to be taking the averager here. Definitely going to want to be taking averages here. Their gross margin has been in the mid-teens. This year was very low due to the fact they probably had a lot of fixed costs that they couldn't make up for, and that does appear to be the case. So pretty poor earnings this year. Cash flow shows a little bit more promising, though. We are seeing probably only 2 years actually of negative free cash flow in the last 10 years. So their free cash flow is more consistent. I do prefer that. Earnings are going to be volatile based on writing off, goodwill of a company that maybe didn't work out, or appreciation, or so many different things. But your free cash flow is really going to be your cash in, cash out, the more confident of consistency here. And we are seeing a very hefty reduction of debt recently, and they actually have no debt now. So I don't like this, though, and I know I've said it multiple times. Even if you don't have a lot of debt, to just have cash on hand, especially for a business as cyclical as this, we obviously free cash flow is less inconsistent, so they are producing positive free cash flow more consistently. But it's just good to have some cash on hand. Again, I'm not saying it's the most advantageous and going to get you the best return, but I think from a safety standpoint and just being confident that you're not going to go under, it works the same for people. Like having a couple months of reserves on hand for you in case of a worst case scenario is not the most advantageous thing for you to do. The most advantageous thing for you to do from a literal return standpoint would be to invest absolutely everything you have at all times, and not having anything left over. And if there's something that goes wrong, just put it on your credit card and you'll be able to pay it off with what you make that month. But there's those things that could happen that you just don't see happening, and that's where risk management comes into where it is nice to have a little cash on hand, even in this case where you don't have a plethora of debt or really any debt here. But it's still good to have a little cash on hand because businesses do not always produce positive earnings and cash flow. But here, I'm just saying, just going on a rant to complain a little bit, but I think I'm ready to start making some assumptions here. So on the revenue growth side, man, I don't know, maybe 0% again in a 10p. So just saying that it essentially earns nothing and deserves a 10% a year, discount rate as a no growth business. That's the formula of equals 1 over, I. So 1 over zero point 0.1 to get you your 10p. I think that seems pretty fair to me. Let's do an average here. Let's maybe do 4, 5 share change. They been buying back shares a little bit, but not really much to offset their stockers' compensation. So let's assume it's flat. And yeah, we're saying it needs to fall 70%. Again, some of these companies that just don't have great returns on invested capital and are not extremely consistent, you're just going to want to buy them really cheap. And some of these stocks that I go through on this generic channel or the generic screener are just going to be ones that you want to get really cheap. That doesn't mean they can't be a great investment. I mean, think about it. The company is probably averaging $10 million a year over the last 5 years in free cash flow. If you could buy this company for $25 million, that's 2.5 times their 5-year average free cash flow. That means in 2.5 years, you essentially get your money back, depending on the ways that they allocate their capital. But that's a great investment. But at this price, I just don't see it being the perfect investment for me. It could be different for you in your situation, but for me right now, this just doesn't make the most sense, and I'm going to be waiting for it to get to a more attractive price. So I hope you enjoy the video. Have a great rest of your day. Thank you.